Welcome to the Capital News. I am your host, Alex Karitis. Today is April 15th, 2019, also known as Tax Day. Did you give Uncle Sam your fair share? Did you? I'm sure you gave him more than your fair share, but that's the world we live in. Got to pay your dues to the man, Uncle Sam. I hope everyone enjoyed their weekend. Thank you so much for joining me. So let's get straight into some of the market news today. The S&P closed down 2 points. The Dow closed down 27.5. The NASDAQ closed down 8 points, and the Russell 2000, the small cap index, lost 6 points to end the day. Oil settled at $63.29. Gold is still below our $1,300 an ounce benchmark, and it now sits at $1,288 an ounce. Silver is also below our $15 benchmark, and silver now settled at $14.90 an ounce. The 10-year Treasury had a little bit of buying, and obviously the bonds are inversely related. So if you have a higher price, you got a lower interest rate, a lower yield, and so yields dropped a little bit, and the 10-year now sits at 2.553%. The VIX, meanwhile, rose 2.6% and closed at $12.32. Now, the stock market, once again, ladies and gentlemen, and we've, called this out because it's, if it happens a couple times, all right, it's something random. If it's something that seemingly happens over and over again with some sort of regularity and consistency, it seems to be a trend. Well, what trend am I talking about? Well, the markets, all of the indexes, the S&P, the Dow, the NASDAQ, the Russell, they were all down. They were a lot lower throughout the day, earlier in the day. But again, if you pay attention to these markets, and you don't have to watch them all day, all you have to do is go on like a yahoofinance.com and just watch the daily chart of it, which is right on its homepage, and you just see, well, it's down, and then whoop, at the end of the day, again, about 1:30 to 2:30, these markets, if they're going down, they make their lows, and that's where it's at. And then, well, you got the last hour and a half of trading, most definitely the last 30 minutes of trading, is where if you see a rally, that's where it takes place in this market. And that's exactly, again, what we saw here happen today. And we've seen this happen numerous times, really since the beginning of this year, when we've had our V-shaped recovery in the stock market. So this is something to pay attention to. I mean, we don't day trade here at the Capital News. I am not a day trader. I rarely am I even what would be considered a swing trader in trying just to find momentum for maybe a month or two or a few months and try to make some profits off of that. That's really not how I like to trade. I'm really not a trader. I'm more of an investor for the long term. But that doesn't mean that I'm not going to sort of, pick my opportunities as I see fit. I'm not going to be right 100% of the time, but at least you do it enough, you get consistent, you get good. So I don't play the day trading game. Right now, I'm not even really swing trading anything. Again, to my positions, I have some longs, I have some things short in this market, and I have some cash built up as well. I mean, you have to be diversified, and you have to be prepared. Because again, according to this program, according to my analysis, the general direction, where we are headed, is down. When's that going to happen? I wish I could tell you. But I don't have the crystal ball to give you an exact date and time. But the risk-reward right now in the type of environment in which we live, in which we're operating, for my appetite, it's too risky. And the reward just isn't there. It's just not there because these markets, again, this is not a random process here because come 1, 2, 2:30, the markets, if they're going down, have bottomed, and now that you're going to have some sort of computer algorithmic trading trying to make this thing rally until it doesn't. And when is that going to happen? Again, wish I could tell you, but I can't. That's why you have to be prepared. That's why you have to be diversified. That's why you have to be ready to enter into these markets if you have a reversal of trend. And right now the trend is to the upside, but that was a V-shaped recovery. So what goes down quickly came back up quickly. Who's to say it's not to go back down quickly once again? And again, we have the president out there tweeting against the Federal Reserve, and we're going to talk about that later in the broadcast. But some of the other things that I want to talk about today, because we are in the midst of earnings season, and last Friday we had J.P. Morgan, we had Wells Fargo, and we had PNC Financial. J.P. Morgan pretty much blew it out of the water. They are a darling of Wall Street. The CEO, Jamie Dimon, is a darling of Wall Street and even Washington. He's sort of the He's sort of the chief banker of all of these guys on Wall Street. When he talks, people listen, or he at least sort of takes the lead. We had a brief conversation last week in regards to many banks, CEOs being paraded up there on Capitol Hill down in Washington. And, well, they all answered questions and gave statements and this, that, or the other. You know, you pretty kind of, you know that Jamie Dimon of J.P. Morgan is sort of the grand poobah there. He's the chief. He's the head honcho. So J.P. Morgan beat estimates. And again, record profits. So much for draining the swamp. The banks, the Federal Reserve, they are the definition of the swamp, and there's no end in sight. They just seemingly cannot lose. You either exist in a world of cheap, funny money, and because these banks are also equities, they're publicly traded, they make out like bandits, which they have if you look at a lot of their share price performance over the years. And now with some increasing interest rates, they now get to make a bigger spread on what they get to borrow against and what they get to lend the money out. So the banks, really, they can't lose. They can't lose. And we talk about that at length in our book, The Cynic's Guide to Investing. So you really have to understand the root cause of the problems here if you want to solve them. And the Federal Reserve and the current banking system and structure in which we have is the root of the problem, along with a lot of the government largesse and the taxation, which, again, it's tax day. Got to get rid of the Federal Reserve, and we have to abolish the income tax. You want to solve the problem. If you don't want to do those things and you don't even mention them, you're not a serious contender, in my opinion. So we will continuously talk about that here until it happens. And we might be talking for a very long time. I mean, optimistic, but let's be realistic too. That's going to be a very large hurdle to make happen, even one of them. But you have to understand too, it's no coincidence that both things, the Federal Reserve and the income tax, both came into existence in 1913. So that ain't no coincidence, and that was a big problem. That was really the start of a lot of our problems that we've been dealing with for a decade. So we had those bank earnings last week. They propelled the markets, particularly the Dow Jones Industrial Average, up over 200 points. Obviously, J.P. Morgan is part of the Dow 30 components, but it was more than just the banking sector that sort of led the rally. We also, again, had Boeing, because you have headline news with Boeing, whether it's good news or bad news, but either way, Boeing has a nice weighting in the Dow. So if there's movements like we had on Friday with Boeing, it moved the Dow to the upside. And when you had J.P. Morgan moving it up to the upside, that's why you had a 200-point gain. But on top of that, not only was it J.P. Morgan and Boeing, but it was also Disney, because Disney was unrolling their what do you call it, their Netflix competitive service, their streaming service out there, and at a very competitive price point. And I mean, it's Disney. Disney is a household name. Everybody knows Disney. I mean, you got kids, grandkids, even a lot of adults still like a lot of the Disney movies themselves. Plus, the library that Disney owns has a lot of adult content too. So it's not just for kids. I mean, it's for everybody. So they will be competing against Netflix. But, I mean, it's not going to be easy to take away market share because Netflix has loyal customers for sure, and they have a lot of good content that's out and coming out. So that's going to be interesting to see, though, if it does eat into their market share and if it starts to become more of a pricing war or a content war. And this is markets, though. This is markets in action. So it's going to be exciting to see how this plays out over the coming years, because I don't think these streaming services are going away. In fact, there's probably just going to be more and more coming onto the mainstream. So it's going to be interesting to see what happens there. Now, continuing our story with the banks in earnings season, we had Goldman Sachs and Citigroup both released their earnings today, and both of them beat on earnings, so profits, but they both missed on revenue. So what's going on here? Because one of the ways, obviously, if you're beating on earnings, you're saying, okay, well, we have our costs under control, or we're doing something to get our costs under control. Okay, so are these just consulting geniuses that they've brought on and now all of their processes are a lot more efficient? Or does this mean that they're laying people off? Or does this mean that a lot of people with their bonuses, even if they are bankers' bonuses, are they getting, diminished? Are they getting lower and lower? So what's going on here? Okay, because they're missing on revenues. That's the top line. That's the sales. So where's all that going to come from? This is what we've been talking about here on this program for the past couple of months, because this is what you were going to see first. You were going to see these types of cost containments taking place by these companies. which, okay, they got to do the cost containment because the revenues aren't there. The revenues are missing. But they have a lot of debt due. And I'm not just talking about Goldman Sachs and Citigroup. In fact, I'm talking about a whole bunch of other companies, the non-financial sector. But this is just the kickoff of earnings season for quarter one of 2019. So there's a lot more to go. You got every other sector, the industrials, the tech sector, everything, okay? So it's going to be interesting to see what happens here. Is there going to be a lot of beats and upward surprises on earnings? But is there going to be a lot of misses to the downside on revenues? Because that's going to be the start of it. You're going to say, okay, well, we laid people off. We maybe didn't pay out as many bonuses, this, that, and the other. That's the start of it, folks, because they have to pay their debts. The piper always gets paid. That's what I've been stressing here over and over to you guys because it's so important. Now, will some of these corporations be able to perhaps roll over some of this debt? Yeah, but what's that doing? It's just kicking the can further down the road. And when you marry that with our other discussions on the demographic cliff that we are facing and will be facing for the next decade and a half, well, where's the growth going to come from to pay for that additional debt that you're taking on? So not only do you have the corporate debt from the issuance of bonds, but you have outright commercial and industrial bank loans, and you also have leverage loans, which we talked about last week, especially taking place in the shadow banking system. That could be a catalyst or a major domino to fall, whether it's the first one or not. It will have major ripple effects down the line. And again, a leveraged loan is just a loan on top of a loan. So this is not good. And even when we start to read the reports of the Federal Reserve and the IMF and some other central banks out there, they are growing more and more concerned with this. All right? You have to listen to what these guys say. You have to listen because they do throw out tidbits of wisdom here and there, and you got to pay attention. And that's what I try to do here on this program, is to go through a lot of these reports, a lot of these studies, and a lot of these concerns that are coming out there from politicians and central bankers. Because, look, when you can have somebody tweet and move the market 1,000 points like the president did late last year, or you have central bankers come in and do a 180 policy reversal and it makes markets rally thousands of points over the coming couple months, I mean, you got to pay attention to these people. I don't like it. It's disgusting. It's disgraceful. It's not how a market is supposed to function, but that's the world we live in. So we have to understand how to traverse it properly. And again, that's what this podcast is all about. So we have earnings coming in. We have to pay attention because this could be the start of companies perhaps beating on the earnings on the profit side, but again, missing on the revenue. So if you're in the midst of a great economic boom, a great economic miracle, as we're told by the president and his administration and so many other genius, quote-unquote, genius pundits on CNBC and Fox Business and Bloomberg, well, then why are these people missing on revenues? If everything is fantastic, if the consumer is so strong, these banks should be making record revenues too, not just on the profit side. Again, you can control the cost by laying people off. And a lot of these people make 6 figures, some of them make 7 figures. So you just saved $1 million right there by laying off Harry. I mean, you know, that ain't rocket science. But if you want to grow market share and grow revenue, you need a strong consumer base. You need strong clients out there. Well, evidently, at least when it comes to Goldman Sachs and Citigroup, that ain't the case. And remember, it wasn't all rosy for Wells Fargo either. They beat, but they gave forward guidance to the downside. And PNC was in line with expectations, so there was nothing stellar with them either. It was just JP Morgan that beat on both sides, but they had some internal issues too, especially with their trading desk. And then again, Jamie Dimon, the CEO of JP Morgan, was out there basically at least sounding to me like he's jockeying for position within the Trump White House because he's saying everything's great. Well, we know from a lot of this other stuff that it's not. It's not. So we're going to keep our eye on this because this can very much be the catalyst that sets everything off. Now, another story I want to focus on was an interview the other day of Steve Eisman. Now, for those of you who have watched the movie The Big Short, which I highly recommend that everybody do so, The Big Short. Came out a few years ago. Stephen Carell, Brad Pitt, a few other big names, Christian Bale. Very good movie. Has to do with a chronicling of the 2008-2009 financial crisis and how a lot of people that they're focusing on in the movie in The Big Short were investors who saw the subprime crisis happening and unfolding and made a big bet, The Big Short, and capitalized royally on the downfall of the, of the housing market and a whole bunch of financial institutions that went along with it. So check it out. But one of the main characters was based off of Steve Eisman, and he's basically a financial guru, a financial analyst guru. Well, the reason why I'm bringing him up is, again, he had an interview the other day, and it was in relations to Canadian banks. And again, the reason why I'm bringing this up is because we have talked about, on a number of occasions, the worrisomeness that I have about many economies, but specifically Canada and Australia, because they've really ridden the super cycle and a commodity super cycle over the past 20, 30 years and haven't really seen any major recession, especially Australia. Now, of course, Canada felt some of the reverberation of 08-09 because they're so close to the United States. Australia was sort of able to shield themselves from it because they're so close to China, and China kept the pedal to the metal with their stimulus and all of their infrastructure spending and a whole host of other things, which sort of allowed Australia to skate by. But now things aren't like they were a decade ago. And so these economies, Canada and Australia, I think are on the precipice. It doesn't mean it's going to be a disaster, but there's going to be a slowdown. It's going to be basically a reversion to the mean, to the average. So they've had above average growth over this period because they've maneuvered well over this commodity super cycle that lasted 20 to 30 years. But now that's unraveling. And there's more competition, and you have a whole host of things starting to slow down together, including China and a lot of Asia. So now you have the likes of Steve Eisman out there who's saying, look, I have some concerns with the Canadian banking sector. And the interview was about 20 minutes. You can find it on YouTube, and I'd recommend, if you like to follow this stuff, that you take the time to do so. And he got, a little bit technical with some of the stuff, but the host of the financial show was basically saying, well, all right, well, walk us through your thesis. Why is this a problem? Why do you see the Canadian banks in trouble? And what kind of trouble are you talking about here? And that was the thing she was really trying to get him to say, because that's what the media wants. They want somebody to come out and say, well, this stock's going to rally 30%. You can bet your last dollar on it, or this thing's going to implode by 50%. And, I stand by that wholeheartedly. He's very measured. He was very careful, and he really didn't want to answer the question. But she asked him, the host asked him so many times, he finally just sort of caved in and said, well, at least at this point, I see a 20% decline in some of these Canadian banking stocks that I'm looking at, and that he's actually does have a short position in. But if you read the body language and the fact that he didn't want to answer the question in regards to what he was forecasting for a decline, I think he's foreseeing a lot more than that, because the host, to her credit, she said, look, there are costs involved to selling these banks short, right? I mean, you have to borrow the shares in order to sell them short. They pay out a 5% dividend that you're responsible for and all this other stuff. So in order to just have this trade, to carry this trade, there are transaction costs with it. And he's like, oh, I'm fully aware. He said, I'm not here to make, to only make 5 or 10%, which, sort of led to his answer of saying these banks are going to go down by 20%. And I think, again, by the body language and just the fact that he didn't want to answer the question on television, says to me that he sees a lot more potential downside. Does not mean it's going to happen. Just because he was right in 08-09 doesn't mean he's going to be right this time. But this is his strong suit, which is why I'm mentioning this to you guys, because we talk about this here. And so when I can mention some sort of expert who knows a lot more about the financial sector and banking sector and how to analyze it properly than I do, I want to bring that information to you. So when you have somebody who can pretty much foresee the subprime crisis here in the United States before 08 and 09, obviously, what is he saying here in regards to Canada? Well, he was also very careful to say, look, I'm not saying this is the quote-unquote big short of Canada, that the housing market in Canada is going to collapse like it did in the United States or anything like that. But he is just saying that Canada is setting themselves up for failure in the sense that the financial sector will once again fall into a regular average credit cycle, okay? And because of the commodity super cycle that has been taking place, Canada and Australia have been able to sort of skate by this, all right? But now things are going to sort of come back to earth. They're going to come back to the average. And he's just saying, again, not a big short of Canada in any type of failure in the housing market, just the credit markets returning to normal, with banks and their non-performing loans and just their average standard losses in a standard credit cycle is going to result in some pretty big losses on these banks. That's according, again, to his analysis. Will this take place or not? I happen to agree with him, and I also am more of the mindset that the housing market in Canada will have some problems. It will have some problems. And if I'm not mistaken, the Canadian government, I think, quote-unquote, guarantees a lot of these mortgages. So this is not going to be good if and when there is a bigger correction in housing prices. So Steve Eisman is out there sending his warnings in regards to the Canadian banks. So I wanted to bring that to your guys' attention because it's important, because it's not just me that's talking about it. There are other experts out there who have made millions and billions of dollars for themselves and for their clients by conducting the same type of analysis and putting their money where their mouths are and reaping the benefits as a result of it. Now, he doesn't have a crystal ball either. He just thinks, look, given how the banks have performed over 2017 and 2018, I think he's really saying that diminishing marginal returns are kicking in with some things, and we are going to, again, come across a regular credit cycle, which the Canadian banks and the managers of those banks just have not seen in such a long time. So they're not going to know how to handle it. And that gives rise to potential panic and a negative shock. And we talk about negative shocks and positive shocks here all the time. And negative shocks tend to be worse than positive because people panic. They hit the panic button and it just, causes more panic and chaos. So you overshoot to the downside. So when he says 20%, I'm thinking probably more on the likes of 30 to 40% is what he's thinking about, and that's probably in the best case scenario for Canada. And that would mean assuming that there is not any type of housing crisis. But if there is a housing crisis, well, then you're probably talking, 50, 60% decline. But that remains to be seen. But again, I wanted to bring that up with you guys because I thought the interview was very interesting. He gets a little technical on the stuff, but it's easy to follow. He does break it down, and the host was a good host. She asked some good questions. She let him talk, didn't interrupt him, and got a lot of good information out of him. So I suggest you checking that out on YouTube if you can. Again, Steve Eisman, Eismann. Very interesting. And again, check out The Big Short, the movie. That would be worth your time too. And lastly here, before we wrap this show up, again, I don't know if you saw it. I talked about this on the geopolitical report because this is very political as well. Once again, our President Trump, is out there to Twitter, but not only Twitter, but an official statement from the White House and the press secretary, again attacking the Federal Reserve, saying they've messed up, they made big mistakes. If they didn't make these mistakes, the Dow Jones Industrial Average would be higher by 5,000 to 10,000 points. Not only that, GDP would have been well above 4%, not 3%. And again, with the revisions of Q4 GDP last year, we have 2.9, so we didn't even have the 3-handle on GDP last year. Just missed it by a bit, but I mean, who's going to shave hairs? Of course, the president would, because he's all about the number and hitting the number. So again, he's out there positioning himself to attack the Fed, to blame the Fed if and when this stock market does again go down, which it will. Markets go up and down. I mean, that's true. I don't like saying that because that's so standard of every other financial advisor out there, but they do go up and down. The fact of the matter is, if that's the case, then what's really the sense of having a financial advisor? I mean, just buy some stuff, hold it, and have some basic understanding of what's going on in the markets and adjust accordingly. I mean, you don't have to pay somebody a few percentage points a year to do that, because you do the math and you look how much that eats into your potential profits over the long term. And I mean, you're making that guy rich. Did he make you rich? So those are some of the things you have to look into. But again, the president is preparing himself to blame the Federal Reserve. Again, he will take all the credit in the world for if and when the markets go up, if the economy is quote-unquote doing well, and you have some numbers out there that show that it is, and I'm not going to argue that. We show both sides of everything here. We have very low unemployment numbers, but again, that's usually the calm before the storm. It's so good, it can only get worse, unfortunately. You have the yield curve inversion that we talk about. Again, recession on the horizon, not imminent, at least historically speaking, but we live in very different times right now. Again, that doesn't mean that this time's different. I'm not saying that, because when you hear that this time's different, it isn't different. That's when you go running for the hills. That's when you really start to look and reassess what's going on. I just mean we're in a financial world of Oz like we've never been in before because of all of the central bank funny money that is just floating around there. Of course, you don't get it. You get it in the form of inflation, but all of the well-to-doers, the top 1%, 10%, because they have financial assets, are making out like bandits again. One of the, if not the largest wealth transfers in the history of the world. And that's not me saying that. That's legendary hedge fund managers saying that. And that was also candidate Trump saying that before he became president. But again, he's taken ownership of the economy and the stock market. And so he wants to dance himself out of the box he's put himself in and wants to blame the Federal Reserve. Again, I have no problem with blaming the Federal Reserve. We want to end the Fed. I just want better leadership from this president. Or, as I stated in the geopolitical report, the president has changed his mind. Those are the only two options we're faced with, folks. He's either dancing and setting up blame for the Federal Reserve and perhaps trying to box the Federal Reserve in, or he's actually changed his mind and believes that this country has to embark on lower interest rates and quantitative easing, which I said on the previous podcast, if he actually does believe this, and that's his new policy stance of quantitative easing number 4 and beyond and lower interest rates, he will not earn my vote. The Democrats won't have it, but the president's not going to earn it because that's not ending the Federal Reserve. That's just giving them more power and influence, and that's just not good. And it does so at the expense of the American people, the vast majority of the American people. And it also has international consequences too, which I just can't stand for. So he won't earn my vote if he actually believes in quantitative easing number 4 and beyond and lower interest rates. So that's something we have to we got to stay on top of it, because as I was making the argument in the previous podcast, it's going to be front and center. The president is making it front and center. The question is, how long will it remain front and center? But regardless of what happens in the 2020 presidential campaign and the topic of the Federal Reserve, it will remain front and center here at the Capitol News. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you as always. Please like, share, subscribe, get the word out. Leave your comments. I would love to hear from you. This is the Capitol News. I am Alex Karitis. Godspeed.